Welcome back. And today we have on the show, Michael Listman. Once again, welcome to you again. I know you're probably not thrilled with me at this moment, but it's great to have you back.
That's right. It wouldn't be the first do-over I've had for interviews, so that's all right.
So, thanks so much for agreeing to do this. We had some questions on that volatility group on Facebook. This is a shameless plug. If you're not on the Facebook group, come join there as we have lots of fun. But there's been amazing public outcry for you to come on and talk about your new successful strategy or your updated strategy from last time we talked, which was what, 2, 3 years ago, maybe.
Yeah, something like that.
And let's see, my buddy Brennan came on and was asking a couple questions. I don't know if I ever told you, but we this guy Brennan's a pretty cool guy. We met over StockTwits and eventually started this Facebook group. He was one of the guys I started it with, and he always is good for some good commentary. And he had posted a couple questions for you as well as some other guys. I think Ivan did as well, asking about basically about your strategy. And I think maybe one of the best ways to address it would be to just talk about your strategy. I would think. But let me just ask you one question from that list that they were talking about. Um, what let's see, what should we start with? Oh, there was a question about hedging volatility and hedging a short vol position. How do you go about doing that, or how do you respond to that?
Right. Well, for hedging, there are really two kinds of hedges. There'd be a par hedge, which where you're trying to match up a dollar for dollar move to be delta neutral. And then there would be a levered hedge where you're trying to pick a product that's going to move exponentially in the opposite direction of your book, uh, so that you don't have to spend as much on the hedge. The issue with trying to do that with volatility is volatility is already a leveraged product, so you're trying to hedge, basically hedge a hedge with the same hedge. We've looked into this before, and every way I've worked the math, the cost to hedge it is no different than just going smaller in your initial position. So that's just left me with the realization that there is no effective hedge for vol.
Now, what would be an example of that first type of hedge you talked about, a par hedge? Would that be hedging like a short volatility position with shorting the mark or shorting the SPY or something like that? Would that be an example of
Well,
that?
like if you had a big SPY book, or everything was beta weighted to SPX, just buying SPY puts or uh, shorting ES futures, anything that's going to give you a one-to-one, basically delta neutral movement, that would be a par hedge. Uh,
It
and
kind of
the idea being that when it moved against you, you could then take that hedge off, collect those profits, and then you basically reduced your basis on your long position.
it seems, yeah. I mean, I've come to a similar conclusion to you, in that it seems like any hedge you put on, it becomes so wildly inefficient that it just starts to crush your profitability. And
Right.
the best idea for most times when people ask me that question, my idea is just if you're positioning sizing appropriately and you're managing your risk appropriately, then the position is the position, and you assume a certain amount of risk, and hedging it isn't really um, the idea. Obviously, people who have big portfolios are hedging those, you buying puts and whatnot. But this isn't a big portfolio that we're managing here. This is a separate strategy. So,
Right. Well, in my instance, it's my entire portfolio. So, but then my hedge is a manual process. I don't have it. It's not on all the time. It's something that I engage when needed.
so let's dig into your strategy. I know that when I first found you, you were on Twitter and you were talking a lot about, I believe you were selling call verticals, and you would come on and you would talk about, oh well, I got this amount of ROI this week on this selling this call spread. Is that still kind of your strategy, or what's your strategy nowadays?
Well, I'll still use that for my IRA accounts that I manage, simply because that's the regulatory requirements is that they need to be limited risk or risk defined. So I will still open up spreads. I My initial strategy, I open them up every week. So I had an expiration every Friday. I would so there's seven weeklies, or they go out 7 weeks with the weeklies, and you insert the monthly expirations in there. So you have seven expirations that I was working at any one time, and I would be 100% deployed across those seven expirations. Uh, when one came off, I put a new one on. Didn't care where spot was. I always sold at the money uh, for the short leg, and whatever width I was grabbing, one up to $5 wide width on those. Um, I lean towards $1 wide now, uh, simply as a ROI function. I'm going to pay more in commissions because it ups your contract numbers, uh, but the ROI is still greater than what you're paying in commissions.
Now we're talking about UVXY here. That's your principal product,
Correct.
right?
Correct.
Of course, I mean, if you change products, you'd have to change your Twitter name, right? Because you are the UVXY
Possibly.
Twitter, so we wouldn't want to have to do that. Um, so, all right, so you were selling essentially call verticals and UVXY. Obviously, now it's a $4 issue, but most of the time it's not a $4 issue, and it's um, so you were selling. So which strike? Obviously, you're selling the lower call and buying the higher call. You're short a call vertical. Um, where was the lower strike that you were selling? Was it sort of at the money to the price of UVXY at the time, or were you selling out of the money spreads? How did that work?
It would be as close to the money as possible, because when you're selling a credit spread, or buying a debit spread, like I do the exact same thing on the put side. Um, and I'd work both sides. I'd work the call side and the put side, just to keep my book straight. Because if I was stepping on another strike with a new open, I might have to go to the put side. But it's the same ROI, the same risk. Um, but when you open those up, basically what you're trading is just on the extrinsic values, unless one of them is in the money. But if assuming they're both out of the money or at the money, it's going to be the difference in the extrinsic. So at $5, uh, say the $5 call might have 25 cents of premium, and the $6 call might have 10 cents of premium. So I would be netting 15 cents on that. Now that's going to change uh, based on the duration that you have. Uh, Obviously, the closer you get to expiration, the larger that number is going to be, because simply the way the gamma curve works, the farther out you go, those farther strikes are going to carry more premium. So it was always a balancing act. And typically for those, uh, my minimum that I would take would be a 20% ROI. So on a $1 wide, I'd be selling for 20 cents. But it could get into the low 30s uh, on spike conditions, and depending on what strikes I picked.
So you would sometimes buy put spreads as opposed to selling call spreads,
Yeah,
just depending on it.
it's the exact same. It's the same trade. It's just the other side of the ledger.
It's hilarious to me that people somehow it for a lot of beginning traders, the mental gymnastics to associate buying a put spread with selling a call spread, they don't recognize that it's the same thing. They think, well, I'm buying a put spread, so I'm actually having to pay out money, whereas I'm collecting money for the call spread, not understanding that when it comes down to how much capital you need to put up for these trades, they're two sides of the same exact coin.
Right.
Um, but that is a question I get all the time from people.
I mean, options in themselves aren't an easy topic. I mean, try to explain just what a put contract is to somebody who doesn't trade, and they might never get it. It's just there's no practical application in everyday life for people to match that up or say, well, if you did this, even the idea of selling first and buying later is a foreign concept to a lot of people that they just don't get.
Right, and the concept with options that you can sell something you don't actually have to start with, because you're not actually selling something, you're making a contract with somebody or a commitment with somebody,
Right.
and sometimes it's it's confusing to people to understand. Now, for me, I was trained through a professional firm and everything, but I'm always impressed with people like you who take the initiative to go out on their own and just figure all this stuff out. What do you think that is within inside you that allowed you to just, go out there on your own and just figure all this stuff out and have the confidence to actually try out all these strategies?
I was just born with an interest in money. I mean, I remember being an 8-year-old kid opening up a lemonade stand on the side of the road and thinking I'm going to make a killing selling lemonade. But I mean, it's always been, you know, learning how money works, realizing that there's a system out there and don't fight it because you're going to lose. Learn the system, work the system.
It's interesting because when I first started trading, which was in the 90s, and could have been arguably said to be the end of the golden age of like raping and pillaging on the floor, but this business was very much a secret thing. You did not share your strategies, you did not tell people what you were doing, you did not share your knowledge because you were kind of banking on the people trading with you not quite getting it, and that was part of your edge. And sharing anything was like, why would you tell anybody what you're doing or what you're thinking or about these strategy about how you're doing things? And the world has changed a lot since then. We're much more connected through social media and whatnot. And but back then it was very secretive, and it's like, no way am I going to tell people what I'm doing, or it was like
Right.
a secret knowledge that's passed down through only the worthy get the secret knowledge. And it's definitely changed since then. So, all right. So that's your strategy um, IRAs or other retirement accounts that are restricted. Now, is that restricted? Does that go company to company, or is that like a federal or state law that says you can't
It's
do certain
federal.
things?
It's
Okay.
it's federal regulations, FINRA regulations, SEC regulations. All there's the regulation T, which is your margin account, and IRAs are not allowed to trade on margin like that.
So, okay, so then I guess that leads me to the obvious question. So now what is your most recent strategies? What have your most recent strategies have what have they been, and how has it been working for you lately?
So about 2 years ago, I moved to just selling naked calls. The thing that everybody tells you not to do. Don't do this. Um, Started doing that about 2 years ago after lots of trial and error with other strategies, and quickly realized that it is the most profitable way to go. And I would argue the least risky if you are paying attention to it and have a plan ready to go for when things go against you. So what I will do, since essentially I'm just collecting a premium, I'm not trying to take advantage of the decay in price of volatility. All I'm really trying to do is just collect that high premium that UVXY carries. Um, on average, it's about 5% a week is the at the money premium. So a $5 uh, contract, if spot's at $5, I'm selling a $5 call. 5% of that's 25 cents. That's what I'm looking to collect every week, with anywhere from 50 to 75% of my book. So if I just run 50% of my book on that $5 call, I've made 2.5% per week. or that week on that contract.
So, um, the numbers don't really change after the split for UVXY, right? It's still percentage wise, it's still going to be
Oh yeah,
5% of. So, this split that everyone makes such a big deal of, is it really a big deal? Is it easier to trade UVXY when, once we've split?
it means, especially for a symbol like UVXY, it means absolutely nothing except you've moved the decimal point over one place. Its price is dictated by the futures. Uh, it doesn't move based on supply and demand or order flow or open interest or anything like that. Uh, if it did, then its IV value, the indicative value, and everybody can look up the symbol UVXY.IV. Um, it moves the exact same way that UVXY moves without ever having a single trade, a single bid, a single ask. It moves the exact same way. So that's hard to explain away, yet people still try to put support levels below it and resistance above it and talk about order flows and things like that, like they have any impact on it, and they don't, unfortunately.
I know. I always find it hilarious that they'll go through this list of stocks and they'll go through their 10-second analysis of each chart and they'll just include UVXY or other ETPs as if they're just exactly like stocks and that
Right.
they respond to supply and demand. And it's like, whoa, whoa, slow it up there for a second. This is not a stock. And it's a complicated product that's based on, an average of two futures, and the two futures, even if you go back another level, the two futures aren't really based on supply and demand for anything specific. You have to keep backing up to get to like the S&P 500 puts, what's trading in those. And by
Right.
the time you've gotten back derived more and more, the number that's on the screen for the price of UVXY is not, there's no correlation between what that price is and some sort of level.
Right. I mean, to be successful trading these ETPs, you need to you need to think like a VIX trader, a VX trader, in the futures, because the futures don't track VIX perfectly. I mean, they've got to keep it in their sights, but there's so many other variables, like uh, if VIX will have certain SPY or SPX contracts drop off and they'll get recalculated. And there was, I think right around the election, there was a big drop. Like the futures were not following VIX like they should have, and everybody was scratching their heads, what's happening, what's happening. And somebody chimed in, well, because this option chain is going to be dropping off the calculation, which included the election period. So even just following the VIX is not, can throw you off. You need to think like a VIX trader or
It's
a
almost
futures
like
trader.
It's almost like the FICA score for your credit score. You got this
Right.
hidden formula that people are kind of trying to derive, and nobody quite knows exactly what it is, and it's always changing. And
But if I pay down my Discover card, I could probably get another 25 points.
right, it's like there's all this stuff that goes into it. And I know they've tried to tighten up. We've definitely seen less like weird tracking stuff happening on expirations over the last year or two. I know they've done some things to kind of, I think, mark the options at some sort of average as opposed to just where it ends the day. They've done some things to kind
Right.
of tighten up the tracking errors on that. But regardless, um it's not something that traditional technical analysis is going to work on.
Right. And I'm not to bash technical analysis, just from the outset, but just as it applies to UVXY and its brethren there, it's just somebody needs to prove to me that that works, and not just a 50-50 hit rate there, but that it works.
So all right, so let me just understand your strategy a little bit better. Um so you're saying that you don't have any like savings in a traditional, like I'm long the S&P Vanguard S&P 500 fund or something like that. This
Nope.
is your main strategy for your savings and whatnot. Um so you're selling UVXY calls And which call as far as strike are you selling in relation to UVXY, and as far as days till expiration, which are you selling?
right? So the highest theta decay is going to be the final week or the very last few days. Um, I mean, I tried to optimize it and say, okay, well, maybe if I just get in like Wednesday evening and just ride the last 2 trading days, because that's going to be the greatest theta decay. But my capital would be sitting idle for 3 trading days, and uh, I couldn't get that to pan out and more profitable or less risky just being in 3 days or 2 days instead of 5. So I usually enter in, if I've got cash available, I'll enter in Monday. I might roll on a Friday. I might let it expire on a Friday, but I'm always keeping at least 50% of my capital deployed with short calls. Um, I'll sell at the money typically because that's where the highest premium is. If I believe there's more decay afoot over the next week, I'll sell in the money. Uh, like the spike that we're just coming out of, it's probably going to go back down to 4. So although I didn't sell the 4s this week, uh, if I had nothing in, I probably would sell the 4s because there's just going to be more total profit at the end when we're done.
Now, do you adjust your behavior when you perceive a spike, like, for example, the last day or two? I know a lot of people are going to be watching this at different times in the future, but like, if there's if we make a 20% move, let's say, in the VIX, and we're in a spike, will you maybe go in a little heavier, or will you change your strike selection to some extent?
Well, once we're in a spike, I'm essentially in full lockdown mode. By that point, I've protected my positions by buying shares or selling in the money puts against that to kind of even out my deltas so that I'm not exposed for any more run up. Unless I have extra capital to deploy, I usually don't. But like yesterday, uh, actually somebody dared me on Twitter to sell calls there, so I did, and it was right at the top when we were hitting like 625 or 630. So I sold some $6 calls, which I bought back today. Um, Made like 80 or 90% on them.
Oh, nice.
But typically, I'm not adding during spikes. Although for my IRA accounts, that is when I do deploy. So for this latest spike, I sold uh, the June monthlies. I think I sold a 5-6 credit spread, so which is already in the money right now. So
So what would you say, like, percentage wise, for your money is in the IRA type stuff as opposed to the quote unquote regular stuff?
the IRAs, since it's all risk defined, and I have that spread out, and I do use other symbols in IRA accounts simply because I don't have as many opening opportunities with UVXY. Um, but in an IRA account, I try to be close to 100% deployed. Uh, in my Reg T and portfolio margin accounts, I'll be anywhere from 50 to 75% deployed. If I get
Well,
over 75%, then I risk being caught with an overnight move.
oh no, what I meant was is like, of X amount of money that you have, how much, what percent is in IRA versus is in your regular account? So it's like 90% in an IRA and 10% in your regular account, or
Oh
how
no,
does it work?
well, I'm limited into IRA contributions, so it can be hard to keep up there. No, I've got a lot more in regular accounts.
Gotcha.
Um,
All right. So I'm sure some people who watch this are going to say, "Oh my goodness, selling naked calls, that's crazy." How would you respond
it
to
is,
that?
it is crazy. Don't do it. Run away. um, I'll use the Volmageddon as an example, or even the spike from last year. Um, I was running both. I was selling naked calls in my margin accounts, and I had spreads in my IRA accounts. The spreads in the IRA accounts got wiped out, so I lost maybe 2 cycles worth of that, complete losses. However, in my margin accounts, I executed my defense strategy, got delta neutral, kept rolling the calls. Uh, I think it took me 5 weeks before I got back out of that trade with a minimal gain, but a gain nonetheless, as opposed to the IRAs, which I probably took a 25% hit on those positions.
So the naked call position actually recovered faster than the defined risk position.
Well, it recovered, period.
Yeah.
Um, it was still, although people say, well, you took a loss on the first call. I picture the whole trade. I consider the whole trade, if I roll it, a continuation of the initial trade. Whereas with the IRAs, I had to just book that loss and I had to make it up with subsequent trades that had nothing to do with the original trades.
So this sort of positioning takes it takes monitoring. It's not just set and forget. You need
No.
to be active in the markets. It sounds like several times a week, certainly. So when do you open and when do you close this sort of a naked call trade, or is it always sort of rolling? Are you always opening some calls and closing others, or how does it work?
As far as monitoring, it's more than several times a week. I would say it's more closer to several times an hour, if not. Usually, I'm sitting in front of a trade desk, and I'm there all day long watching it. If I'm out playing golf or doing something else, I'll have my phone with me, and I'll always pull it up just to check. I've got a feel for the market conditions, so I know how often I need to check. If it's spiking, I'm checking every 2 minutes or something, because it can change in a heartbeat. But um, no, basically, if I'm fully deployed, there's not much more that I'm going to do for opens. I might manage things around the edges, but if I'm lightly deployed, I'm always looking for more entry opportunities. So if there's a spike in another week, I might take that as an opportunity to add more. If there's a nice dip, I might uh, sell some puts against that, just because there's premium down there I can collect. Not as much, but some. I might trim some, I might roll some, but the bulk of the activity comes on Fridays like today, where I'll roll positions out or wait for them to expire, or Mondays when I'm deploying new capital.
So I know I emphasized this before when we were talking. I kind of want to do it again, which is just to tell people who maybe are new to this sort of stuff, on a Friday expiration, when you've got those short units and you're coming close to expiration and the strike may be close to the underlying price. um, it's important to cover those for that couple. It usually costs just a couple pennies to cover these things if they're close to at the money. And I always like to just emphasize to people when we have this sort of discussion, cover those units for that. If you give the market maker that last 5 cents or whatever, let them have that so that you can have the peace of mind to not know, to know that you're not going to get assigned on these things and have to have that risk.
Right. Yeah. No, I'm just as guilty as anybody, getting greedy in the last. I want that 5 cents. I want that 5 cents. Especially if I've got 100 or 500 contracts riding on that 5 cents. It's real money, but you get burned on that one or two times, and you're like, I'll give them back the 5 cents. I don't need this that badly.
So Um, so what do you tell, uh, obviously you have a pretty big following on Twitter. What do you tell people that want to replicate this strategy? Because I mean, to play devil's advocate, if you're short, if somebody's new and they get short and they're short some naked calls, there's some risk overnight where you can't, the market's closed. And if it opens and it's gapped in one direction, obviously, if it's gapped up, then if somebody is not managing their risk appropriately, they can end up owing money to the clearing firm or whatnot. So how do you advise new traders about that sort of situation?
Uh, don't do what I do. Don't do this, because while it's successful, I've made it successful. I've watched other people have problems with it. Um, the most important part is the trader that's executing the trades. You can give anybody the perfect safest plan in the world, but they're going to make changes or not execute it the same way. I subscribed to some auto trading services once, and they did very well. They promised or promoted that they'd make 10% per month, and they did. But of course, looking to tweak it and optimize it, I changed things, and for a while I made it much better. I was making 10% per week, but then I didn't manage the way they did it, and I blew up a couple times. So, and that's going to happen if you follow anybody else. You can't follow them exactly. And if you don't understand how they designed it and why they designed it that way, you're not going to execute it in the same way. So if somebody else wants to do this, I would recommend just doing a one lot for a year. You need to see this trade through everything that the market can throw at you, and most importantly, understand how you react to those situations. Um,
That sounds
you
like
know, if,
excellent advice. All right, so walk me through. So, things are going well. You sell calls, you collect money. You sell calls, you collect money. Then one day, I don't know, 2 years ago, the president tweets something, and the market, and there's a spike. You come in. How do you manage when things don't go well?
so it's it's discretionary, of course, um, but I need to make an assessment about the cause of the spike and how long I think it's going to go. Uh, One problem that I see a lot of people get into is they're very inflexible in their biases. Um, they've they've told themselves a story or they've heard somebody else's story and they think, okay, the market's overvalued, it's due for a big correction. They're printing money recklessly, it's going to crash. So every time it starts to move, they pull that narrative in and factor that into their decision making. Whereas I try to make this as neutral and clean as possible. I say, okay, what's causing this? Um, this was last week was the CPI number, so just a little inflation scare. I checked the bond market wasn't reacting, so all those factors went into my assessment that this was probably going to be short-lived and not very high. So my first step was to sell in the money puts against it to collect a little premium to give me a little extra wiggle room. um, Once it blew through that, I then went fully protected. I bought shares. And at that point, I was delta neutral and it could have gone to 100 or 135 again, and I wouldn't have cared. Um, and then when the spike looks like it's over, I start to pull those back off. So the shares I put on at about 550, took them off at about 550. So that was a scratch. I ate a little bit on the puts simply because I didn't close them yesterday and it opened up down, what, 40 cents this morning. So I didn't eat much. And actually, last time I checked, I'm flat. I'm exactly where I was Monday. So it was like a scratch for the week on me.
You're gonna go into the market if we start to spike it. You're gonna go to the market and cover those deltas by buying the
Right.
underlying or selling puts, and then try not to get whipsawed as things come back down. Take that off, and everything's back to normal again, sort of thing.
Right. And this defense whipsawing is the biggest risk. Last March there was no whipsaw because it went up. I defended and it just kept going. So there was no opportunity for whipsaw. The GME fueled spike in January, there was a whipsaw, and I got beat up pretty badly on that. Uh, took me about a month to recover from that, but I've far surpassed that level by now, especially with 2 months of solid decay.
I guess that brings me back to one of the questions on the Facebook group, which was they were asking what sort of drawdowns you had, because I think people speculate that maybe you've had some big drawdowns just because of the risk that you have taken in the past. I think that's probably what that guy was getting at when he's asking. Yvonne was asking about what sort of drawdowns you've had.
Right. Well, and it's all again, It's up to the individual trader what they're comfortable with. I will. I'm ready to take a 20% drawdown, uh, and for me, that's not a permanent loss. I'm not closing out that trade. That's my that's my delta neutral level is at a 20% drawdown. And since I was light this last week, that was limited to about 12%. That was the farthest, the deepest drawdown I had in any account. Um,
So you manually stop yourself out. If
I'm
UVXY is
manually
4,
stopping.
you say 525 is 20%. Hits 525, I'm covering my entire position at that point.
Right.
And like you
And
said,
this,
if you get a situation where it's several days that it's moving higher, then you're loving it because your exposure is gone, and it can keep moving higher to the moon, and you don't care.
right. In my ideal world, we would have closed out this week at 550 because then I would have pocketed all of the premium that I had collected on those
From the
puts
puts. Yeah.
instead of giving it back. So I would have made money on my hedges this week if it had stayed up there, but unfortunately it dropped back down. But it's this is a grind trade. I'm in it for the long term. Uh, I'm just playing the averages, and I'm not gonna. I'll never hit a home run. I'll never be the guy that buys UVXY at 14 and watch it go to 135. That's not. I'm never gonna make that trade.
Well, I think, I mean, although it's interesting because me coming from the market maker world, there never was a bias saying, "Oh my God, you're selling naked calls." It wasn't like that at all. It was like, "Oh, that's one strategy is to sell naked calls, another strategy is to do this." It was just another strategy. And I
Right.
think that's because we had access to essentially unlimited capital. Capital was basically like we judged having capital as what's my cost of carry to borrow that money from someone. It
Right.
wasn't like
Right.
I get to $3 million and I'm tapped and someone's going to tap me on the shoulder and say, "You're fired." It was like, okay, if we need another $3 million, we just got to borrow it and pay the interest on that.
Right.
And so it wasn't like, uh, it wasn't, and it's a different mentality to come from a world where maybe you're managing a bunch of customers' money and you're looking to try to get a specific conservative return. That's a very different thing than um, having judging your own risk comfort as a person and operating within those bounds. And I think some of the debate that goes on in our community is uh, people coming from different levels of risk tolerance and having different people that are managing customer money and having to respond to the customer and justify all their decisions to that customer versus a trader who needs to know themselves and to understand themselves to maximize their profitability.
Yeah. There's a lot of people, and you look at things, people like Dave Ramsey or Susie Orman that recommend no debt. Debt's evil. Get rid of your debt. But every corporation's carrying debt. Uh, every trader that has access to all this Fed money will borrow as much as they get access to, because if I can borrow it at 1% and even make 10% off of it per year, I'll borrow 100 million tonight. Where do I sign? So, I mean, there are always different types of debt, but when
Right.
you're
Let's make the
leveraging,
distinction between that and somebody borrowing on 20, borrowing 10 grand on 25% interest rate on a credit card. That's a little different because
so I
you're
can put
not
a
going to be able to
stereo in my
make,
car or something
yeah,
like that.
right. or thinking that you could, that you can trade well enough to surpass that 25% interest rate and make money on it. That's a little different than
Right.
borrowing money at, 1% or something, of course.
And you also need some confidence. I mean, if you're going into business and you're like, hey, I need to borrow 100 grand for inventory, you've got some confidence that you're going to move the product. Same thing with trading. I've got to have some confidence that this trade is high probability. I'm not going to risk this capital. There's no way I'm going to borrow 100 million and do something stupid with it or crazy, low probability with it, because that'll ruin you.
So what are your what are your thoughts? How do you tell people to get started trading these products? So I know, I'm sure there's a lot of people that follow you on Twitter that are like, "Hey, I want to do that too." And it's certainly risky, and it's certainly, you know, we don't want to see people blow up, obviously,
Right.
which
Well,
happens.
oh yeah, it happens. Well, realizing that the most important part is the actual trader and not the trade. I would encourage people to get a full options education, and if you want to lean towards what I'm doing, I would recommend going to Tasty Trade and learning from them, because uh, they are all about selling premium, all about premium collection. They go through all of the metrics of it, different ideas and different positioning, all the different option strategies. Um, get a handle on what premium collection is all about, and as opposed to chasing an alpha move, just price action. Um, and then from there, obviously I took what they teach and adjusted it for a single underlying. I'm not trading small and trading often. I'm trading one and trading it all. Um, but take the good knowledge that they have and fit it to your style and your risk tolerance.
I remember I got a quick lesson my first year as a market maker. I was trading Cisco Systems, and I went into earnings and I sold some straddles, and it worked out great. So the next earnings, I doubled my position, and it worked out great again. You can see where this is going, but
Yep.
I ended up being short a lot, and I did get whipsawed. Some news came out, the stock was down like $5. I panicked and I sold a bunch of shares, like, to defend my position. And by the end of the day, the stock was unchanged, and I had to buy those shares back. And the lesson was, A, I was too big, and B, for me nowadays, if I'm trading an equity position and I'm short a bunch of straddles or something and it starts to get me in trouble, as opposed to defending my position, what I will do is I'll start to cover a portion of it so that I don't get whipsawed again. And it's a different strategy than trading VIX products, but the lesson is to to manage your risk appropriately, and not blindly sell premium, which I had to learn the hard way. A lot of us have to learn the hard way.
Right. And there are so many different ways to approach it. When my initial response to a spike might be to collect more premium and get larger, maybe not expose myself more on the call side, but adding more positions, adding more short puts. And there can be a point where I'm like, I need to start trimming this back because my book is getting a little unwieldy here. So I'll start to trim and just cut back and even things out and reduce where it makes sense, if I'm not leaving too much money on the table. Uh, just to try to keep it sane and manageable.
I also learned a lesson in UVXY in 2017. I would say I want to make a little bit of extra income by selling some puts, and I got run over a bunch of times by selling puts too cheaply. They're like way out of the money puts in the front or second week, and all of a sudden they just got completely run over, and my profitability in the calls got canceled by selling these cheapo puts to try to make an extra $25 here and there. So
Oh yeah. Puts The put side scares me way more than the call side, because I can keep rolling the call side. And if you pull up a 10-year chart, you see that the call side is eventually going to expire worthless. Might not be this week, might not be next week, but it's coming. Put side is like going long the stock. Uh, eventually you're going to be bag holding that, and
and it
you're going
might
to be
never come back to that level
yeah,
again.
never come back.
Yeah.
Like after this next split, the the initial offering price is now what, $2.4 billion per share. That's never coming back.
And people don't get that. It's weird. People see that and they're like, "Oh, well, maybe, there's a chance." It's kind of like, I don't know if you're familiar with Dries, the shipping company, that it was
Oh
a
yeah,
stock.
yeah,
It's like, well, if it was way up there, let's see if if there's even a remote chance it's worth putting some money in, because even if it gets halfway, I'm a zillionaire. Well, it's like, No, the futures that UVXY was based on back then have been expired for years and years and years and years, and they're not,
Yep,
and it would take the market going way below zero for it ever to get back there.
right.
Cool. Well, listen, thanks. Thanks for redoing this. I really appreciate it.
No
I
problem.
felt like an idiot, and but such is YouTube and the beauty of YouTube. So, will you pare back your positions when you go on the road, or will you manage it from while you're on the road?
Uh, no, I'm not going to pare it back. So my goal is 100% per year, double your money every year. And to do that on a compounded basis, I need a 1.345% return per week on average. Um, so whatever I need to do that, if I can do that with just half of my capital, I will. But I've always got my phone with me. I'll be checking it, based on market conditions. If I know that I need to be checking it more frequently, I will. But typically, like over the past 2 months, I'd only need to check in 3 or 4 times a day if I'm on the road. Uh,
So,
but even that would be
do you plan on going full time as a trader at some point?
uh, I don't know how I'm not already. I don't know what else I could do more that would fill up my day, but um, I don't want to give up golfing or leisure activities and be tied to a computer for 10 hours. I think what I've got going on here is the right balance. Um, you know, I do monitor it, through the night, through the day. I'll check the phone 2 or 3 times overnight, and then
I
I'm
guess, I guess,
watching.
I guess what I mean is you have another job besides trading, correct?
I have some other companies that I'm actually divesting myself of this year.
Oh,
So
okay.
yeah, trading will be my only vocation after this.
Now, this is just one last question for you. When you hear about people, maybe through Twitter or whatnot, that say, "I'm going to become a full-time trader," does that make you cringe? Do you think that it's a big pressure thing for people? Because it would seem like people might jump on that too soon a lot of times. What would be your advice to somebody who's thinking about making the leap to full-time trader?
Um, I mean, I encourage it. Lots of people can do it, but you need to make sure that you're qualified. I mean, you can't say, "Oh, I'm going to be a brain surgeon," and quit your other job if you're not a confident brain surgeon already. So prove that you can do it first before you quit your job, sell your company, or whatever you're going to do, and work your $5 million cash pile down to 50,000. Because I've seen that way too many times. Talking to my accountant, telling me stories about people said, "Yeah, I'm just going to stay home and day trade," and they start out with a big pile of money and just keeps getting smaller. So, and unless you've proven to yourself that you can do it, I would be cautious. But to just blanket poo poo it, I'm not going to do that.
Is there is there some sort of like situation that like a market condition that would have you just take your positions off and wait for a little while? Like like if it starts getting really wacky, like at the beginning of COVID, for example, things seemed really wacky. Or is it just a thing where you feel confident in in your strategies that it'll weather the storm?
I will change it. Like when this would be in 2017 when VIX was trading. I think there was a print under 9, but it was trading in the nines for a while. And right before the Volmageddon, I didn't listen to myself, but there was like no more juice to be had in my trades, and that should have been. I was forcing at that point, but when there's nothing, no profit, when the risk seems a little too high, that would be the only time I'd say, okay, let's do something else.
So if like implied volatility in UVXY were in like the lower 10 percentile or something like that, it just wouldn't seem. It seems like right. I mean, I'm glad that they announced a split because it kind of. I just didn't want to trade UVXY with it $4 stock. I just it just didn't seem worth it to me. I know percentage wise it's the same thing, but just psychologically, it just
Okay.
didn't seem worth it.
It depends on what you're doing. I
Yeah,
mean, for
yeah,
me selling options, like I really needed a $4.25 strike or a 4.75 strike for my stuff to work, and it's not there.
right.
So when I've got to reach for something 25 cents lower than I want to be at, there's just not enough premium there. So I've got to start being creative with an option strategy instead of just naked calls or puts or straddles. I've got to start reaching out into jade lizards or zebras or things of that nature to try to make it work.
Well, good news. It's 10 days. It's we're back in a new. It'll be $60 again, or
Well, but still there's a problem because even though it'll start trading with a decimal point moved over one, and that looks like it's going to be in the 30 or $40 range right now.
right.
Um, the options market won't be caught up for a while. Brokers seem to take their time listing in their systems. You know, that you might have to call the trade desk and, oh, it's trading under this symbol and it's 10 characters long or something. Um, New options are released every Thursday, and I know the split happens on a Wednesday. So even if they do list options that following Thursday, I don't think the brokers are going to be up to speed. So there could conceivably be 2 weeks where you don't have access to the new standard options. So what I'll probably do before those options go non-standard is I'll load up 2 weeks out and just call it good.
And just leave it.
Yeah.
Yeah. Cool. Well, listen, it's always fascinating to talk to you, and I'm glad I caught you before you got on the road. We have to give the people what they want on Facebook. So there you go, Facebook people. There's your interview that you've called for. I'm still waiting for the call from Julia Cordova to be on her show. She said she was going to bring me on. It hasn't quite yet, but yeah.
I'll pressure her for you.
Oh, thanks. So, yeah, don't be a stranger. And when you are in the area, feel free to look me up. We'll jam some tunes or something.
All right. Sounds like a plan.
All right. Thanks. Thanks a second time. And I will talk to you later.
All
And
right.
thank you for watching, everybody. And we'll see you next time on the Short Vol Show Live.